Before we go any further, do me a favor. Mute the television, shut down the extra browser tabs, yes, all of them, including the ones you don't want to explain. Give me a few minutes of your full attention, because what I'm about to lay out isn't a guess, a forecast, or some flashy theory designed to get clicks. This already happened. It's done. The only thing missing is public acknowledgement. Something broke while most of the Western world was distracted by geopolitical noise and weekend headlines. It didn't happen during market hours in New York. It didn't happen with a press conference or a breaking news banner. It happened quietly, late Thursday night, January 9th, 2026, on the other side of the world. And it happened in a place that actually matters when it comes to real metal, not paper promises. The Shanghai Gold Exchange failed to deliver physical silver, not failed in the polite way the financial industry likes to redefine the word. Not a shipping delay, not a systems error, not a mismatch that gets smoothed over by Monday morning. This was a failure where the metal simply wasn't there. Vaults opened, requests were made, and the silver did not exist in anything close to the required quantity. Here's what that looks like in plain terms. On that Thursday, the exchange received requests for delivery totaling 64 metric tons of physical silver. For the world's largest physical metals exchange, that number should be uncomfortable at most, not catastrophic. In a functioning market, it's routine. You might sweat a little, you don't collapse. So how much silver was actually delivered? 1 ton. 1 out of 64. That's not a rounding error. That's not a hiccup. That's a 98.5% failure rate. Put differently, for every 100 ounces of silver that were legally demanded and contractually owed, only about 1.5 ounces showed up. The rest may as well have been a fairy tale, printed, promised, traded, and ultimately imaginary. This isn't a squeeze. It's not a shortage in the usual sense. This is a default wearing makeup and hoping no one notices. Technically, it qualifies as a force majeure event, but that phrase hasn't been used publicly yet for one simple reason. The moment it is, the global silver market stops pretending and starts panicking. So instead, the language being floated is softer. Settlement issues, logistical complications, temporary delays. It is the financial equivalent of saying the plane is just circling while everyone can see the engine on fire. Let's slow this down with numbers, because numbers don't have emotions or incentives. 64 tons of silver equals roughly 2 million troy ounces. 1 ton is about 30 to 150 ounces. So what actually happened was a delivery of roughly 32,000 ounces against a demand for about 2 million. Once you see it laid out like that, the word failure almost feels generous. Now compare this to New York. COMEX registered silver, the metal supposedly available for immediate delivery, sits around 30 million ounces. That sounds substantial until you remember that open interest on COMEX represents hundreds of millions of ounces in paper claims. In other words, a small fraction of holders asking for real metal would drain the system completely. And here's the uncomfortable question. If Shanghai, backed by China's refining capacity, domestic production, and state involvement, can't deliver 64 tons, what exactly do people think happens when pressure hits New York? The answer is simple. The same thing, just louder. This delivery failure matters because it marks the point where the split between paper silver and physical silver stops being theoretical. For decades, the market has been built on a convenient assumption. A paper claim on silver and a physical bar of silver are essentially interchangeable. If prices diverged, arbitrage would fix it. Buy here, sell there, move the metal, pocket the difference. That mechanism broke on January 1st, 2026, when China implemented its export licensing system. Moving silver out of China became extremely difficult, if not outright impossible in practice. The arbitrage bridge didn't crack, it was blown up. By late December, the consequences were already visible. Shanghai silver was trading around $89 an ounce, while New York sat near $75. A $14 spread in what INS is supposed to be a unified global market is not normal. It's a warning light. We said it wouldn't hold. We said something would snap. What snapped wasn't price, it was delivery. And no, this isn't because China ran out of silver. China is the world's largest silver refiner. The metal didn't disappear, it was redirected. This is where the conversation gets uncomfortable for people who prefer tidy economic models. We are entering a war economy phase globally, and silver is not just a shiny store of value anymore. It's a strategic material. While media outlets treat global events as isolated stories, they're all connected. Look at Iran. Protests have escalated to the point that internet access has been shut down in multiple cities. Reports of violent clashes are coming out of Tehran. U.S. leadership is openly discussing intervention scenarios if the situation deteriorates further, with analysts floating a 30 to 60-day window for serious escalation in the Persian Gulf. Now look at Venezuela. The U.S. government has announced moves to unlock and liquidate tens of millions of barrels of Venezuelan crude oil held under sanctions or strategic arrangements. Officially, this is about stabilizing energy markets, Unofficially, and far more realistically, it's about cash flow. Wars are expensive, and modern ones burn money faster than oil. What does a modern military actually need? Steel, oil, lithium, rare earths, and silver. Silver is embedded in missile guidance systems, radar arrays, advanced electronics, satellite infrastructure, and defense communications. Patriot missile systems use it. Hypersonic platforms use it. Advanced naval and aerospace systems use it. When nations prepare for conflict, they stockpile what they can't afford to run out of. That's why the silver isn't sitting in exchange vaults anymore. It's sitting in government depots, military reserves, and defense contractor inventories, whether that's in Jiangsu province or Nevada. Civilian markets get what's left, and increasingly, that answer is not much. This fits a familiar historical pattern. First comes financialization, trading paper instead of producing goods, then debt accumulation to sustain the illusion, then currency debasement to service that debt. And finally, the war economy, where resources are redirected toward military power in a last attempt to preserve dominance. In that final stage, commodities vanish from open markets. Not because demand disappears, but because governments claim priority. So when Shanghai couldn't deliver 64 tons, that wasn't just a market glitch. It was a signal. Cheap silver belongs to a different era. Silver is being treated less like a commodity and more like ammunition. Which brings us to the question everyone is really asking. What happens to price when the world catches up to this reality? Even the mainstream analysts, usually months late and several dollars short, are starting to react. Reports from Asian and Indian commodity desks are remarkably aligned. Monday, January 13th, 2026, is being described as a potentially historic session for silver. The expectation isn't a gradual climb, it's a gap. A jump at the Asian Open, with silver potentially opening between $82 and $85 an ounce. No polite price discovery, just a teleport from Friday's close to a new range. In India, where silver trades on the MCX in rupees per kilogram, analysts are watching the 253,000 level as a breakout point, with fast targets near 260,000 rupees. Those prices would mark new all-time highs, not by a little, but decisively. Why the confidence? Because the Shanghai failure isn't a rumor in Asia. Traders in Mumbai, Singapore, and Hong Kong know exactly what happened, and they're not waiting for confirmation from Western headlines. Physical metal is being bought this weekend at almost any price, because once the delivery data is widely digested, the scramble will be brutal, and that's the part most people still aren't prepared for. The gap up, dramatic as it may be, isn't the story. It's what follows when confidence in paper silver doesn't just erode, but breaks, that will redefine the market entirely. At this point, the most important thing to understand is that once a major exchange fails to deliver, the bridge between East and West doesn't just crack, it collapses permanently. And when that happens, the paper price flashing on a screen in New York stops meaning what people think it means. It becomes a reference number, not a source of supply. Think about how this actually works in the real world. Imagine you're a serious industrial buyer, not a retail investor stacking coins in a safe, but a company like Samsung. You need 10 million ounces of silver to keep your electronics production lines running through the first quarter of 2026. Assembly lines done, T-wait. Engineers don't accept excuses. You either have the metal or factories go dark. Historically, sourcing that silver was straightforward. You'd call your broker in London or New York, buy futures contracts on COMEX at spot, stand for delivery, and take the bars out of a vault, JP Morgan's most likely. From there, the metal ships to your refinery or factory. Efficient, boring, dependable. That's how the system was supposed to work. Now imagine standing for delivery and being told, politely but firmly, we don't have the silver. Here's cash instead. Cash doesn't conduct electricity. You can't solder a circuit board with a wire transfer. You can't build solar panels with an apology letter. Industrial demand doesn't care about settlement language. It needs atoms, not accounting entries. So what do you do next? You bypass the exchanges entirely. You go straight to physical dealers, refiners, and private vault operators. And you don't ask for the spot price. You ask one question only. How much metal do you have and how fast can I get it? And they respond with a number that makes your procurement department uncomfortable. Spot is $78, they say, but physical is $95. Take it or leave it. And you take it, every time. Because the alternative is shutting down production, missing earnings, and explaining to shareholders why you trusted paper contracts in a physical shortage. That dynamic is no longer theoretical. It's already happening. This is the premium explosion that has been discussed for years and dismissed right up until it arrived. Try buying physical silver today. Call a dealer in the US or Europe and ask for a monster box of American Silver Eagles or a few tubes of maple leafs. You're not paying $2 or $3 over spot. You're looking at $10, $15, maybe $20 per ounce in premium. Dealers aren't being greedy. They're being rational. They know what Monday morning looks like. They know demand is about to surge, inventories are thin, and restocking may be impossible at any reasonable price. So they protect themselves by raising prices now rather than apologizing later. What this creates is a two-tier market. On one level, you have the paper universe, COMEX futures, ETFs like SLV and PSLV, where prices still hover in the 70s or low 80s. On the other level, you have the physical world, coins, bars, allocated storage, real metal you can touch. That market is already drifting toward $90, $100, and in some cases beyond. And here's the part that should make people uneasy. That gap doesn't narrow over time, it widens. Because once confidence in paper silver cracks, everyone tries to exit at the same time. ETF holders look at redemption clauses. Futures traders suddenly want delivery, and they all discover the same thing. The metal isn't there. That's how a bank run works, whether it's dollars or silver. The first people through the door get paid, the last ones get a lesson in contract law. This brings us directly to the silver ETFs, because a lot of people are exposed here without fully appreciating the risk. The largest silver ETF in the world is iShares Silver Trust, ticker SLV. On paper, it holds roughly 500 million ounces of silver. The custodian responsible for storing that metal is JP Morgan. We also know from multiple disclosures and long-standing reporting that JP Morgan controls a private hoard estimated around 750 million ounces. On the surface, that sounds reassuring. Plenty of silver to go around, right? Here's the uncomfortable question. Whose silver is that, really? And more importantly, who benefits if the market breaks? If you're running JP Morgan and you control 750 million ounces of physical silver, and you can see prices heading toward $150 or $200 because of a global supply shock, why would you hand that metal over to ETF shareholders at $80? You wouldn't. No rational actor would. The far more profitable move is to allow the ETF to cash settle, pay shareholders the paper price, and retain the physical metal. 6 months later, you sell that same silver to Apple, Tesla, or a defense contractor at double the price. That's not villainy, that's incentive structure. And yes, the SLV prospectus allows for this. Buried in the fine print is the right to settle in cash during market disruptions or shortages. What do you think a 98% delivery failure in Shanghai qualifies as? This isn't hypothetical risk anymore, it's precedent. If Shanghai can cash settle nearly all delivery requests without blinking, there's no reason to believe Western ETFs won't do the same. Imagine redeeming your shares at $85 while physical trades at $120. Legally permissible, financially devastating. That's why anyone holding silver ETFs needs to reassess immediately, not next month, not after earnings season. This weekend, the risk-reward profile has flipped. 2 weeks ago, SLV looked like a convenient proxy for silver exposure. Today, it's a wager that a custodian will voluntarily sacrifice future profits to honor paper claims. That's a bold bet. Now, to be clear, this isn't a call to panic sell at any price. It's a call to recognize that the rules have changed. Exposure is no longer the same as ownership. The obvious alternative is physical metal. Yes, premiums are painful. Yes, storage and security are inconvenient. No one enjoys explaining to their insurance company why there's a small fortune in the basement. But physical ownership removes counterparty risk. When systems fail, that distinction becomes everything. There are middle ground options, like allocated storage programs and trusts, such as Sprott Physical Silver Trust, PSLV. PSLV differs from SLV in meaningful ways. It's domiciled in Canada, uses the Royal Canadian Mint for storage, and allows for physical redemption above certain thresholds. Structurally, it's more transparent and arguably safer. But even that comes with caveats. In a war economy, sovereign risk isn't theoretical. Governments requisition strategic materials. Export controls get imposed overnight. If silver is deemed essential to national defense, and that argument is already being made, legal ownership can be overridden. In that scenario, a trust share is just another promise, which is why, uncomfortable as it may be, the safest position remains direct possession, coins, bars, private vaults you control. It's old-fashioned. It's not sleek. But when exchanges fail, ownership is the only thing that counts. Now, let's talk about COMEX, because if Shanghai was the first domino, COMEX is wobbling hard. Registered silver, the metal actually available for delivery, sits around 30 million ounces. Against that, open interest represents somewhere between 500 and 700 million ounces of paper claims. That's a paper-to-physical ratio of roughly 16:1 to 23:1. Historically, this imbalance worked because most contracts never went to delivery. They were rolled, closed, or settled in cash. The system relied on apathy and habit, but psychology changes fast. Once traders see a major exchange fail to deliver, the instinct flips. I want my metal now. That's when delivery notices spike, and when they do, the exchange faces two terrible options. Raise margin requirements to force people out, which signals distress, or declare force majeure and cash settle everything, which confirms the metal never existed. Either path destroys confidence. There is no clean exit. What makes this more dangerous is the steady vault drain we've been watching for months. Registered inventory keeps falling. Eligible inventory stays flat. That tells you metal is being moved, registered, delivered, and removed immediately. The smart money is already leaving the building. Some argue JP Morgan could step in and save the exchange. Technically, yes. Realistically, no. Saving the exchange is not profitable. Letting it fail is. If COMEX cash settles at $85 and JP Morgan sells physical at $120, the math speaks for itself. That's tens of billions in upside. So the timeline here is short. Days or weeks, not years. The system isn't breaking slowly, it's cracking in real time. Which brings us to the only question that really matters now. Knowing all of this, what do you do next? Let us anchor this in time so there is no confusion about how narrow this window really is. Today is Sunday, January 11th. Tomorrow, Monday the 12th, some Western markets are closed, but Asia will be trading as usual. Then Tuesday, January 13th, New York and London are fully back online. That's when the entire world will be staring at the same data, at the same time, and reacting all at once. Right now, you still have the luxury of choice. In a few days, you may only have consequences. If you own silver ETFs, this is your moment of truth. You need to decide whether you genuinely trust that your ETF will honor its promise of physical backing in the middle of a global delivery failure, or whether you accept that paper exposure is no longer the same thing as ownership and act accordingly. There is no neutral position anymore. Doing nothing is a decision. If, on the other hand, you already own physical silver, congratulations. Your decision-making process is refreshingly simple. Don't sell. You are holding the winning ticket, even if the number on the screen doesn't reflect it yet. The price you see quoted, $78, $80, whatever it flashes tomorrow, is not the real price. That's the paper price. The real price is what desperate buyers are willing to pay when supply disappears, and that price is much higher than most people are prepared to accept emotionally. Selling physical silver right now for fiat currency that S being printed faster than it can be trusted makes very little sense. That currency is losing purchasing power by design. Silver, on the other hand, is gaining strategic value by necessity. One is being diluted. The other is being hoarded. History is very clear about which side of that trade works out better. If you're looking to buy silver, you're facing a different kind of discomfort. Premiums are already ugly, and they're about to get worse. Seeing dealers charge $15 or $20 over spot feels wrong if you were used to normal markets. But here's the uncomfortable truth. The spot price is the price of paper. The premium is the price of reality. In a shortage, the only price that matters is the one attached to actual metal. That said, discipline matters. This is not the time for leverage, not futures contracts that can be cash settled, not options that can expire worthless while trading is halted, not clever structures that rely on smooth market functioning. This is the time for simplicity. Physical metal, coins, bars, allocated storage, something you can point to and say, that is mine. Something that doesn't vanish because a committee invokes a clause on page 47 of a prospectus. Brace yourself for volatility, because the next couple of days will be chaotic. Once the mainstream media catches on, and they always do, eventually, you'll start hearing phrases like unprecedented and unexpected. Analysts will pretend they're shocked. Retail investors who couldn't tell you the difference between an ounce and a kilogram will rush in, panic buying silver because it's suddenly trending. That wave alone can push prices sharply higher. But don't be surprised if that spike is followed by an aggressive pullback. The banks have one play left, and they'll use it. Dump paper contracts, smash the price, shake out weak hands, and try to restore confidence through fear. It's a familiar routine. Don't fall for it. The noise doesn't change the signal. Shanghai failed to deliver. The physical market is fractured. That's the story. Everything else is theater. We've seen this movie before, even if the cast has changed. In 1968, the London gold pool collapsed under its own weight. Central banks had been suppressing the price of gold to protect confidence in the dollar, selling reserves every time demand pushed prices higher. For a while it worked, until it didn't. Vaults drained, deliveries failed, the system cracked. The solution back then was a two-tier market, official gold at $35 for central banks, free market gold at whatever price buyers and sellers agreed on. And once that split happened, gold didn't gently reprice. It exploded. From $35 to $180 in a few years, then over $800 by 1980. The suppression failed and the rebound was violent. Silver is following the same script. For more than a decade, its price has been capped by paper selling, synthetic supply created out of contracts, not metal. The world was told silver was just another industrial commodity, abundant and boring. Meanwhile, vaults quietly emptied. Now they're empty enough to matter. There's a more recent parallel too, and it's worth remembering. September 2019, the US repo market seized up overnight. Banks stopped lending to each other. Rates spiked from 2% to nearly 10% in hours. Why? Because the collateral everyone assumed was there wasn't. The system had been running on leverage and confidence. When confidence broke, liquidity vanished. The Federal Reserve stepped in, printed hundreds of billions, and papered over the problem. That emergency response set the stage for the even larger printing spree that followed in 2020. The lesson was simple. When the system breaks, authorities print. The Shanghai silver failure is the same type of event, just in a different corner of the financial world. It's a collateral crisis in a physical market. Paper claims were issued under the assumption that physical metal could always be sourced. That assumption is now false. Authorities will respond the same way they always do, with liquidity. They will print currency, expand balance sheets, and attempt to stabilize confidence. But here's the catch. They can't print silver. Every dollar they create makes the shortage worse, not better. That's the loop they're trapped in. Don't print, and markets implode. Print, and hard assets reprice violently upward. Either path leads to the same conclusion. Silver wins. As for timing, no one has a perfect clock. But this isn't a multi-year story anymore. Based on delivery data, premiums, and vault movements, we're talking weeks, not months. The January delivery notices will be revealing. If demand spikes, and there's every reason to believe it will, the panic will be immediate. Once confidence is lost, price discovery stops being polite. In shortages, price isn't set by supply curves and spreadsheets. It's set by fear, urgency, and who needs the metal more. $100 is conservative. $150 is realistic. $200 isn't crazy if things escalate. And if force majeure is declared, if ETFs cash settle en masse, if governments step in and classify silver as a strategic asset, then traditional price targets become meaningless. At that point, silver isn't being priced in dollars. Dollars are being measured against silver. None of this is random. It's the collision of three forces. China's export controls removed a massive chunk of global refining capacity overnight. Geopolitical tensions are pushing governments to hoard strategic materials. And industrial demand, from solar, EVs, and electronics, keeps rising regardless of price. Supply can't keep up. Something had to give. It gave in Shanghai. That's why this moment matters. A bank run on silver has begun. Shanghai was the first institution to shut the doors. COMEX is wobbling. ETFs are exposed. When all three disconnect, paper and physical prices will live in different universes. If you own paper, you get the paper price. If you own physical, you get the real one. This is a Lehman-style moment for commodities. The difference is that no central bank can print its way out of a physical shortage. You still have time to act, but that clock is ticking loudly now. Get out of paper silver. Convert exposure into ownership. Do it while markets are still open, and dealers still answer the phone. By Tuesday, that may no longer be true. This isn't hype. It isn't clickbait. It's a warning. Shanghai failed to deliver nearly all the silver it owed. If that doesn't force a reassessment of every silver contract you own, nothing will. The paper silver era is ending. You're watching it happen. What you do next will matter for a very long time.